A special lecture by Professor Parthasarathi Shome. It's my privilege to introduce Professor Parthasarathi Shome, a distinguished public finance economist and tax policy expert. Professor Shome is the founder chairman of the International Tax Research and Analysis Foundation and has made seminal contributions to tax policy and public finance over several decades. He has served as the director of NIPFP and also held directorship of ITRAF. Internationally, he serves on the academic board of the Advanced Diploma in International Taxation of the Chartered Institute of Taxation, London, and also on the board of directors of the International Tax and Investment Center, Washington, D.C. In recognition of his outstanding contributions to tax reform, Professor Shome was conferred the Commander of the Order of Southern Cross, Brazil's highest civilian honor for foreign nationals. A prolific scholar and policy advisor, he has authored over 150 research publications and several influential books spanning taxation, fiscal policy, public finance, and governance. Today, he will deliver a lecture titled The State of Domestic and International Taxation, Selected Concerns. The session will be chaired by our director, Dr. R. Kavita Rao. May I now invite Dr. Rao to kindly take over the proceedings.
Thank you, Resham. I'm not going to be doing a great big introduction of any sort. I'd like to recall, as we mentioned in the previous session, that Professor Shome was with us about 30 years ago to the date. 30 years ago to the date. So it's a pleasure to have him back in the room. We were to have the Revenue Secretary chairing the session, but given the exigencies of the Parliament, he has not been able to join us. So I'm trying to fill in the shoes. We won't take any more time, sir. We are already running a little late. So we would kindly request you to start.
Thank you very much. Good evening. I am absolutely delighted to be here. 30 years back, as Professor Rao, Director Rao pointed out, I was here and we celebrated the 20th anniversary of NIPFP. It was a kind of a very grand occasion, but Kavita has decided to celebrate it over the entire year. Of course, it is the 50th anniversary. So Kavita, thanks very much for inviting me, and Suranjali Tandon, who has also invited me. So without further ado, I will start. My agenda today, to the extent that I can, is to cover a kind of a sweep of Indian taxation in the new millennium, so to speak. So it is a little broad brush, but I thought, given the enormity of the audience and from different areas, I thought this is the best way to kind of target my talk. Firstly, there are some things that are, I want to talk a little bit about the individual income tax, what has happened in the recent years. First, in a unique feature, there are now two alternative regimes. One is the old regime, which continues. The rates are 0, 5, 20, 30. And together with a plethora of incentives, which are for health, which are for provident fund, other savings, and so on and so forth. Typically in sections 80C, section 10, 80D, etc., for covering all these various kinds of incentives. And however, if you are willing to forego these incentives, then you come to a simpler regime, which is the new regime. And there the rates are actually more diverse: 0, 5, 10, 15, 20, 25, 30. And one might say, oh my God, it is very complicated. But if you really see, it really doesn't matter when you are filling in your form, whether, as long as you know what is your taxable income, and the rate automatically will show what it is. In fact, in the US, the form doesn't even say what is your tax rate. It simply calculates and tells you this is what you pay. So it is a kind of an innovation, but what's the advantage of this? You see, when you have so many rates, the impact of fiscal drag becomes less, because your next marginal rate is just a little bit higher. Whereas if the next marginal rate is much higher, you are dragged up willy-nilly to a big jump. So first you cover for fiscal drag or bracket creep, whatever you want to call it. The second thing is, what they have done is they have increased the basic exemption and standard deduction. And so while you are giving up incentives, you are getting better standard deduction and so on and so forth. So I feel this is quite an innovation. Frankly, not too many countries, I mean, very few countries, if at all, have this kind of innovation. Is there any issue with it? Issue with the, yes, still, I feel yes, because there is the issue of marginal income tax rates. I don't want to begin the talk with this, but I feel that the rates 10, 20, 30 plus the surcharge is still quite low compared to comparable countries in terms of emerging economies. If you really see even South Africa, Singapore, of course, is the highest per capita GDP in the world today, unbelievably, but it does. So in India, why do I say that? I'll explain to you why. Because in our country still has one of the lowest per capita GDPs. Second is we have an expanded taxpayer coverage now under the GST. So we know that it is a little bit regressive, the GST, because more people are being brought from the bottom because they are consumers. And we know that because consumption occupies such a big portion of their income, they are therefore taxed more. So I think that it is very important to keep that in mind, and we have to make a comparison and see where we are too low for the 30% rate. And my feeling is that it is time that we consider at least an additional 35% rate. Another innovation which is very good that has happened is the taxation of a second abode. For a long time, many of us had said that at least a second abode house should be exempted. It was not listened to, like many researchers, we work for what we believe, but it doesn't. And the thing is, the important matter is that if you had one house, however tall, however large, it was exempted. But I always give an example of an elderly couple had bought a small flat in a building, and now after retirement wants to buy another flat in the building. That second flat would be taxed. And I felt that was extremely regressive and inequitable. And I'm very glad that in 2019, a second abode was exempted, that it could be declared as self-occupied whether you did so or not. So this was another thing that they did. It has many caveats attached to it about whether you can take a loan, whether you can make a repayment of your principal and get a deduction for it. Is there a cap for it? There are some things like that. But on the whole, your second home is also, that is legally second home, is also now exempted, which is a very good aspect, I feel. I'm trying to point out what are the things that that has happened over the recent years. In corporate income tax, again, there are two regimes now, and it depends on which one you select. The first one is where the original one remains. And together with that, you can take all kinds of incentives, mainly profit-oriented incentives. You deduct your taxable income, and the whole thing comes under the section 115 BAA. On the other hand, if you forego incentives altogether, then your tax rate falls from 30% to 20%. 30% is the regular rate. So you give up your incentives, you pay at 22%. And this is again something that you don't see across the world. And India has innovated in this manner. However, there is an issue, and that is the very prevalence of incentives in the 30% tax rate does create distortions. Because as long as you have incentives, some people are getting it and some not. And therefore, this could be taken as a good first step, but something has to be done to get rid of incentives. And in 2006, we had introduced a method of estimating revenue loss through incentives. And that has gone on. It is published every budget. And that shows that there is a huge amount of revenue loss still going on with incentives. So I feel that has to be done. There are many other matters. This is in the statement of revenue impact of tax incentives. It comes under in the Union Budget Annexure 7. So every year that shows that we have a depletion of revenue because of incentives. And incentives, I've found over the years, are very deleterious in terms of neutrality among different sectors. And over the years also, if you see who have gotten the incentives, they are not necessarily very deserving sectors. So there's a lot of politics involved in it, etc., etc. So getting rid of incentives is the best thing. Okay, now I'm coming to this very special feature in the Indian income tax, and it parallels many other countries. It's the minimum alternate tax. Now, because of incentives, no country gets actually the tax revenue reflecting the headline tax rate, as it is called. It might be, let's say, 30%, but you don't get 30% of your profits in taxes because of incentives kind of erode the base. As a result, most countries have a minimum alternate tax. The US has a minimum tax. Canada has a minimum tax focused on mining and quarrying. EU has a minimum tax, EU-wide minimum tax. Morocco has a minimum tax which is based on turnover. Latin American countries, Mexico, Brazil, Peru, etc., had minimum taxes which were based on gross assets. And why gross assets? Because the idea was, suppose the tax rate, corporate tax rate is 25%. And a viable company would have to get a medium to long-term return of 6% of gross assets. That is a minimum. Otherwise, you wouldn't survive. So what that means is, in order to survive, you are getting 6% of gross assets. And then if the tax rate is 25% of CI in corporate tax, then your gross assets based minimum tax would be 25%, the tax rate of 6%. So that is how much? 1/4 of 6 is 1.5. So that is the 1.5% of gross assets would be your minimum assets tax, minimum alternate tax, but it's based on gross assets. So many Latin American countries were doing that. Of course, they also gave carry forward, carry backwards. Mexico had many features, but it didn't survive. It had, I think, over 10 years it survived. At the 10, I'm not entirely sure now, but because it may have been more. But eventually they had to take it away. And Brazil kept it on the books at 0%. So they didn't have to do the new legislation if needed again. So that is the minimum alternate tax. In India, what is interesting is that it is based on what was defined as book profits. And what are book profits? They are all there. You have to put back many items that you generally deduct in order to calculate taxable profit. Things like reserves, and provision for reserves. Then if subsidiary companies make losses, you again ignored those losses. So you put it back as a profitable, taxable income. Dividends paid out or proposed, you again put back. And then expenditure relatable to exempt income. If you are taking the exemption for a part of your income, but if you have done some expenditure with respect to that income, you could take out that expenditure, no more. If you have exempted income, you don't. Then some depreciation. Then if you defer your tax payment and say I'll pay later, sometimes that is allowed. That was not allowed. You couldn't provision for deferred tax payments before. If you provisioned and said I'm keeping this money because in the future if I'm not doing well, I can take money from there and pay tax, that was not allowed. You could do it, but you are not going to get it as a reduction in your tax base. And similarly, if you provision for future diminution of asset value, then you had to put it back. So your taxable profit, the general one, you had to put back these kinds of things in order to get the book profit. And so if your income tax payable turned out to be less than 18.5% of this book profit, then nevertheless you have to pay 18% of this recalculated book profit. This is India's way of calculating or constructing or designing the minimum alternate tax. And this book profit concept actually also changed over time, but has now stabilized for many years. It is very unique. It is very unique. At the beginning, many Western countries, they wondered, what is this book profit? There's no such, accounting concept, etc. But it worked very well and it has stuck on. But this is a very interesting thing. If you really see in 88, 89, when the MAT was originally introduced, what I did here was the original corporate tax rate, including surcharge, is shown in the upper graph, and the lower one is the MAT rate that was there. And actually the dotted lines show the actual numbers, and I simply fitted a regression line in each of them. And you see that there was no relationship between the two in the early years. And there are some years you can see, for example, 2008-9 to about 2012-13, it went up, down, up, down. There was no pattern, but eventually a pattern emerged, and they were converging the rates towards each other. What that meant was the companies would have to pay a fixed proportion of the headline corporate tax rate as minimum tax, and the closer it came, the better. So today the distance is the least. The MAT is 15%, and the headline rate all put together, such as settled about 27, 28%. So it is the closest, and perhaps it will come closer and closer. So it means that eventually we might just expect companies to pay the minimum tax, and that is it, and you get away from it. So again, I think this is a very unique feature. Now, before I get out of income tax, I want to also admit the two unsuccessful attempts to cut tax evasion. Actually, three. The first two were very much during my tenure in the ministry. The first one was fringe benefits tax. That was an attempt by government to curtail tax evasion, not even tax avoidance, because corporates gave huge amounts of benefits, which were called fringe benefits, which they were supposed to report. And the beneficiaries, who were the staff, the high corporate executives, etc., typically gyms, holidays, you name it, and the staff would get cafeteria benefits, tickets, this, that, tickets to cricket matches. We found all kinds of things. So we decided, following the example of Australia and New Zealand, which didn't, however, actually introduce it, but studied the Fringe Benefits Acts in great detail. We introduced it in 2006, as I remember. And so the what we did was, all the fringe benefits were divided into 3 categories, and it was said that for this category we will take 1/3 of the fringe benefits as taxable income. For this category, half, and this category 2/3. We meant 3 groups, and those were calculated and added as profitable income and taxed at the corporate tax rate at the corporate level. Still, it didn't work, because administratively it was being cross-checked with the actual staff. What is it that you receive? Where are your bills? Where are all these proofs? Actually, when one reflected later, I thought that was not needed. We just need, but even that would have met with a lot of problems, because corporates wouldn't accept that how can you just presume we are giving this? We are not. In our corporate, we don't. So we said, okay, you keep your bills, and we will take 1/3 in this group, 2/3 in this group, half in this group. And there was a lot of hue and cry. And the media, especially some very respectable dailies, they criticized, and somehow, I don't know why, I alone was identified as this is the Shome tax. And I became one of the most unpopular persons in Delhi parties. And I went to my bosses and said, what is this? This is happening. And anyway, we stuck to it. And it was eventually removed by the next finance minister in the same government in 2009. Another second tax was BCTT, or Bank Cash Transactions Tax. This was the Hawala problem. There was a lot of money taken in, taken out, and you couldn't really trace these transactions, how much is going in, how much is coming out. So what was it, that a 50,000 rupee, first it was only 25, it didn't work. I was opposed to it right from the beginning. We increased it to 50,000 for individuals, and I think 1 lakh for non-individuals, that you can take only so much in a day. You can take out only so much in a day. And the problem with BCTT was that there was no real complaint about it. So it was also introduced in the same budget 2006. It was again removed in 2009. One could say, oh, they wanted to remove both at the same time. The other argument is that there is no explanation. So my conclusion was that in India, you always have to see the practicality, quote unquote, of things like that. And in 2016, another attempt was made through demonetization. We all learned it was very successful, this and that, but then eventually the full circulation thing came into being. And as I recall, chairman of NIPFP, Ujjit, he did a very good job, but he kind of stuck to his point that I think, I don't want to quote him, but I wonder whether he necessarily agreed with the government view that it was successful. So I feel myself that from what I have read, mainly through newspaper, very solid newspaper articles, that all that money in circulation is back. So if anti-evasion measures through tax and non-tax measures have been tried, but unfortunately they are very difficult, and I know that it is one of the most ardent wishes of every government that comes to India, but it just doesn't work. The next thing I want to say is talk about some of you who have done work in have worked in tax administration. This is again an innovation of the new government. It's called faceless assessment. And what is the faceless assessment? That individual income taxpayers, there are about I think there are 8 type of return forms. ITR1, which is the simplest, like you have savings and salary and pension, and then you have ITR2, which are a little more complex. You have some capital gains and so on, and then from 3, 4 it gets more complicated. And so everyone has come under something called faceless assessment, which means that you file online, and if an assessment officer has a question, in the old days, the assessment officer could summon you. Now they cannot. And you don't know where exactly your return has gone. Before, if you were in Delhi, there would be an AO who would do it in Delhi, and you would see the name signed in the assessment. Now, the Delhi assessment could go to Chennai, or it could go to Bihar, or it could go anywhere. And so you had no idea. And the officer also would do it anonymously. However, if the assessment was not agreed upon by the taxpayer, then the taxpayer could request a personal interview. But sometimes the taxpayer feels compelled to see, and the explanation of what is this, and it is unpopular with both taxpayer and tax administrator. Why? Tax administrator used to take pride in an assessment. They had to sign it. It was her or his assessment, and bosses in the administration department would see the quality of the assessment and so on. Now that quality, I feel, is not assured. Still, the best officers do always the best. But in order to have a minimum quality, you must have. So what do you do about it? And my suggestion is that the simplest returns, like ITR 1, of which there are lakhs and lakhs, you keep under faceless, because you don't need to see an officer and so on and so forth, and you keep it under faceless. ITR 2, which is a little more complex, you give a taxpayer the option to do, because you are getting options in income tax, corporate tax, etc. So no harm in giving faceless assessments also a little option, and say that in ITR 2, you can either opt for faceless or you opt out of faceless. But for the complex returns, faceless assessment has not worked. And therefore, I think my suggestion is, before it becomes worse and worse and more unpopular, take faceless assessment out for all those complex ITR returns. You better have it, for example, you see sometimes that there are, in the complex returns, thousands of pages which are attached. And I cannot believe that an anonymous assessor is going to nevertheless spend all that time, or is given all that time, to inspect very carefully thousands of pages. So the quality obviously will go down. Therefore, this is my simple suggestion. Categorize, keep the easy returns under faceless, but as the returns forms get more and more complex, you begin to take out from faceless. But this is also an innovation, and the idea is very good. You have to optimize how we actually go about it. So the thing is, I've heard them say there is no pride in the order anymore. Okay, now I am going to goods and services tax. Goods and services tax also, as we know, it was finally introduced in 2017. The first report on GST was submitted on December 31st, 2007. And it was a cooperation between the central government and state government. And the whole process went on silently between the states and the center. And the draft of the GST was prepared step by step, went through the Ministry of Finance, then all line ministries had to sign off on it, and then it went to the Law Ministry to see the legal language. Then it went to the Finance Committee of Parliament, and interestingly, Mr. Yashwant Sinha was the chairman of the Finance Committee, though he was in opposition, and he also signed off, etc. So it was very surprising that just before the 2014 election, it was announced that the then government would not introduce it. So some of us who had worked very hard on it found it perplexing, to say the least, except that I lost several nights' sleep wondering what happened. And so the next government, which is currently prevailing, got the platform, and they used the platform to introduce it in 2017. And so the first thing was they didn't want to wait anymore. And in retrospect, I think that was a good idea, because at that time I said so many, loose ends. How is it going to work and all that? I was quite critical of it. I wrote about it. Now I see that it has worked, but the sufferers are the suppliers and the purchasers, the businesses, because so many things were unclear and so on. But now slowly things have fallen into place, but not everything. So I'm going to say, and of course, structure, I won't say, that there's the central GST, there's the state GST, they work in cahoots among the states. The consuming states it's a consumption tax, GST, like VAT. So the consuming states get more, because that is where the net consumers are, and the producing states actually ship off, and they are not getting the revenue. So they originally complained, but GST was so revenue productive that the complaint stopped. And so it is and then at the central level, there's no problem. But what happens, the revenues are collected, but then there is a transfer mechanism from the producing states to the consuming states. And there is a body that is controlled by the center, operated by the center, that solves this transfer problem. And so that there would be no tussle among the states to say, okay, this is acceptable, this is not, and so on and so forth. So it has taken hold. Then what has not yet worked? I think I'll first say what has not worked, and then I'll say, nevertheless, what is working. So the first thing that has not worked, let me see if auto population. What is auto population? There was supposed to be, there are three forms: GST R1, GST R2, GST R3. The first one, the GST R1, was for supply. The suppliers had to fill in the GST R1, and GST R2 was for purchasers. But of course, every supplier or whoever is producing, whoever is supplying in the market, they are the suppliers, and the purchasers are the same. Suppliers will have to purchase things, and so when they are operating as a purchaser, then they have to fill in the GST R2 form. Interestingly, the idea was, as soon as they entered the tax identification number or TIN, having done GST R1, they do the GST R2 with the same TIN. Automatically, the GST R2 is filled in, and it gets kind of enmeshed into GST R1. So you see what is the net, and that is done automatically again in GST R3. In fact, the thing was set up that on the I think 10th of the month GST R1, and then the dates. And by the 15th GST R2, and then by the 20th GST R3. Now that is all being done. The forms are there, but that automaticity has not happened. And some of us were very much in favor of the private sector, so it was given to the private sector, and it has not happened. So sometimes I feel that the government sector IT department, probably under pressure, could have delivered it by now. So this has not yet worked, and it is a little. And so as a result, what happens is that data are accumulating. The automatic processing of data and all that is not working fully because there's no auto population. The system was also supposed to give a star system, and that star system was, if you were a very good supplier, you would, without any litigation, without any question with government, you would get 5 stars, and then 4, 3. So if you're a purchaser from that supplier, you would know what is the star. Should I go into this or not? That also, I don't think, I've not seen anywhere that it is working. So that is also something that needs to work. What are the positive administrative steps? First, this is a very big thing for a complex country like India. By the way, India is the only country that has a fiscal federal value added tax or GST, meaning full-fledged central government and state governments together operating a GST. It has not worked in Canada, which is, of course, US doesn't have a GST or VAT at all. And the two other possibilities were Brazil and Argentina. Argentina couldn't devise it, and Brazil does have a VAT which also includes which specially includes the states, but the center really doesn't have one. It is basically an excise-based system. So India is the only one that has somehow managed to come up with an excellent tax. But remember, there were 10 years of preparation in this. So it needs at least that much time. But of course, India is a very complex case. The positive thing is that today, only 1/3 manual tax returns are being filed. And the others, 2/3 are automatic, means you don't have to go into a GST office. So that's a huge achievement. 2/3 of the GST returns are being done non-manually. And so then similarly, the movement of goods, the tracking can be generated and followed. And it is also possible through the systems-driven setup to check if a supplier is filing returns or not, and so on. And there is a data analytics tool that is helping to identify fake suppliers, because there was a huge incidence of suppliers who over-reported their incomes and sales, because that would qualify them to get bank loans and other credit. And this now can be checked, and fraudulent filing can be pursued and are being pursued. And if a chain of suppliers is tracked and mismatches in what they are doing are identified, then of course immediately investigation, etc., start. So it is a good thing. However, there's one little thing, caveat, and that is always there was a problem of refunds in the case of value-added tax, excise tax, etc., especially for exports. Now, exports, you are supposed to get refunds immediately because it's a zero-rated tax. I mean, zero-rated VAT should apply, or GST should apply, because it's exports. You can't export a commodity with embedded tax. So you need to give refund of the input tax credit immediately. Like advanced economies give it immediately, and if there are questions, it is investigated later and then followed up. But in India, that checks and balances, they are all done by the administration beforehand. Now, so there, India really loses out in the export market. So that has to really be curtailed. Now I come to customs tariffs. Customs tariffs. So, I won't go into great detail. Mainly, I want to talk about customs tariffs, the Trump tariffs, because I think that's interesting. India always had high customs tariffs. We had a high tariff wall for infant industry arguments and so on and so forth. Some were 100%, 150%, even 300% in the 60s, and because consumer goods were stopped and the foreign resources, exchange resources, were reserved for industrial growth. Now, I still am old school and believe without that industrial growth, India would not have been where India is today in terms of international competition and so on and so forth. But that doesn't mean that the customs tariff wall should have continued for so long. So the previous government tried very hard. Not all cabinet members had agreed, but tried very hard to reduce it and at least reach for zero tariff trade with ASEAN countries, because ASEAN countries have zero tariffs among themselves. So that was tried, but it didn't work. It didn't happen. But so India is considered to have taken very long to shed its. And then, however, in around 2015, for the first time, the direct tax to GDP ratio went over the indirect tax to GDP ratio. And it was like it crossed. So I call it a scissors curve. But again, 2000, and that is what we always wanted, that direct tax in terms of GDP would be more. But in 2019, because of the declared objective to encourage value addition and local industry, tariffs for all increased. So again, we had indirect taxes go up in terms of GDP over direct taxes. So again, you had a double cross, so to speak. And then on top of that, the GST came in. Even though GST is almost a direct tax, we include it as an indirect tax because it is only on consumption and it doesn't include savings. So it is not on GDP like the case of income tax. So GST is considered an indirect tax. So it now goes into the calculation of indirect tax. So it is going to remain this way now. And so in a way, the direct indirect differentiation has lost its meaning because of the preponderance and importance of the GST in India today. So now, however, it is time to reduce willy-nilly our customs tariffs, and there's no other way. In February 2026, suddenly the US announced from the Rose Garden that they feel that there is unfair trade against the US conducted by the rest of the world. So the president declared from a chart what they have calculated. What they felt was there is a need to impose customs tariffs on countries depending on how much is the imbalance of trade with that particular country. So how was that calculated? Here, I have put it in a simple formula, which is suppose that the US goods trade deficit with country A is X dollars. It has a deficit. US has deficit with most countries, but suppose it is with country A, it is X dollars. And the imports from that country have the value of Y dollars. Then according to the US, the tariff rate would be X over Y. That is the trade deficit over the total imports of goods from that country. However, that US decided to not impose the X over Y tariff rate, but then you divide again by 2. So half X over Y percent, what was called the reciprocal tariff rate, or RTR. Now, this was obviously not quite correct because the trade deficit also reflects US's overconsumption pattern, the consumption pattern of the country. It reflects the senior edge it has gotten through post-World War era, from printing dollars, and with prints, the rest of the world takes the dollars, and the US can the rest of the world can buy the dollars, and US can then spend the dollars. So all of this has happened, but nevertheless, it took this as a criterion and said, and at the same time, non-tax barriers by Europe were well known. Undervalued currency of China was well known. High tariff wall of India was well known. So US had good reason too, but not the explanation of this formula, but it was imposed. Now, what I said was that as a result, this formula resulted in tariffs of 20% on EU, 26% on India, 46% on Vietnam, 145% on China, etc., etc. And but you see, this half, that was a random factor. And I remember the president saying that we are not putting the whole thing, but only half, just to be kind. So I called it the kindness parameter. So if you are India, US is not so kind to it because it didn't like it, then that could be half could be increased. Or if it was doing good, then kindness would increase and the half would be decreased, and so on and so forth. And in fact, from that day, that half, if you believe that x over y remains the same, but that half, which I have called finally as a generalized term b, that has been going up and down with respect to different countries. So this is a very important thing. Now the world knows it is not enough to develop geopolitical relationship with the US. You better do something about your tariffs, and be careful about how much you also increase your imports from the US, so on and so forth. So this is the situation of the customs area. In India, I think, realized also all of a sudden, unanticipated, that it has to modify its dynamic of customs tariffs policy. Now I come to the second, it is not second half, it's shorter, but is the second part, which is the first part up to now was all domestic taxation issues. Now I'm talking about some domestic, some international, which are emerging from international taxation matters. So first issue is that of indirect transfers. We didn't ever talk about indirect transfers, etc. earlier on. Then the issue of indirect taxes came up because there was a case of Vodafone against the government of India. And here I will explain the difference between risk versus uncertainty later. Another point that I'll touch upon is the general anti-avoidance rules of GAR. Then I'll talk about digital services tax and what is the relationship with virtual PEs, permanent establishment. I'll explain that a little bit if I have time. And finally, that's not there, but finally I'll talk about a little bit about taxation of robots. That is very important because I feel that it is time that we think about it seriously. In the case of Vodafone and Hutchinson, both were multinationals that had their capital abroad, but they had, well, the capital assets were in India, but they were multinationals headquartered abroad. And Vodafone bought the assets based in India, but none of the transaction took place in India. So it was a transfer of assets based in India by two multinationals that were entirely abroad. And by law, that was called indirect transfer of assets. Indirect because it had nothing to do with the two multinationals in India. Multinationals were not present in India, but they were India-based assets. When that happened, the tax authorities wrote to the Vodafone authorities or executives saying that please withhold tax from Hutchinson. And Vodafone said, sorry, there's no tax provision on the basis of which we can do it. So they didn't. And then as a result, the tax authorities passed a law saying that these indirect transfers are taxable, but not only are they taxable, they actually will be taxable retrospectively or retroactively, and that retroactive point went back to 1962 of the 1961 Direct Tax Code. It was implemented from 62, so it had a law saying that whenever it goes back to 62, there was an uproar globally, and so I was called to look into it. And what we found was that yes, there was no law. The law had to be introduced, and there's nothing we found why indirect transfers could not be taxed and why the revenue from the taxation should go only to the foreign multinationals in their own home countries, home base. Part of it in the supply chain and the location of the assets should come to India. But we found fault with the retrospectivity or retroactivity of the law. Why? And this is where I felt that we have to explain the what it causes. And what does it cause? Here, I said that there is a difference between two concepts, risk and uncertainty. If you are undertaking a business, you undertake a risk and you decide how much to invest, where to invest, etc., reflecting your attitude towards risk. Either you are risk averse, or you are risk neutral, or you are a risk preferer. But reflecting that risk, you make decisions and you start your business. But suppose 5 years later, you are told that, suppose this year when he began was 2000, but in 2026 you are told, sorry, you did it in 2000, you've been operating from 2000 to 2026. But actually the law was not that. The law was that you had to give your tax based on sale of assets and any other transfer to the country, and you should have done that from 2000, and we can go back and tell you, you give that amount now. Either you go back to your seller or you give it from your own pockets. Now that is beyond the risk factor. That causes uncertainty, and I said this causes, in bracket, impossibility to perform. And I was extremely opposed to this thing going back, any number, and it went back to 1962. I was really surprised as to who thought of it. And someone is here who knows very well on that. But anyway, so and he's smiling wryly, so I would love to hear from him. But then, so the government then formed a committee, and the committee said this, that you can't do it retrospectively. And the then government, where I was ensconced, however, dilly-dallied, and they said, oh, whatever. And however, this government, I must confess, the new finance minister, this finance minister, it didn't happen under Mr. Jaitley. He had just come in and then he was gone. And so they took away, they made a declaration that no assets, existing relationships will be taxed retrospectively. They will not declare any retrospective action. However, they didn't take away the statute from the books. And therefore, I think it is still unfinished business. They have to do so. I'm now, I think I was retired till Kavita and Suranjali dragged me in. But I think that the next generation has to pick up this, because if we want a proper business to function, then it is very important that we make it viable for business to operate. Keep risk. They have to take risk, but take out uncertainty of this kind exogenously imposed on the taxpayer. So that is the thing. Then the next one is again kind of related. In the same year, what happened was this idea of GAR, general anti-avoidance, is to go after major corporations if they are avoiding tax. And in what way are they avoiding tax? Go to the last bullet, and that says, if you employ mechanisms that are not employed normally for bona fide business purposes, you've set up something artificial which doesn't reveal bona fide business. Second, you have not dealt with your business transactions at arm's length. What that means is, even if you have a subsidiary, what prices are you dealing between yourselves? The prices must reflect market prices. And if it is too far from market prices, it is called not at arm's length. Then third, you have abused the provisions of the direct tax code. So you've played lots of games with the direct tax code, and despite the intentions of the direct tax code, you've reinterpreted somehow or the other. You have been doing that. And finally, very clearly, your enterprise doesn't have economic substance. So these ideas were what the government was trying to go against. Now, most developed countries already had GAR, and they had fine-tuned and worked on it. But what I found in my committee, when we went into it, it was found that it seemed to me very clear that India took the most harsh elements of every GAR and put together its GAR law. It was passed in 2012 like that. But this cannot happen. I mean, we have to fit it to our needs and do it. So of course, and then again, the GAR committee was formed, and I suggested some names who are really great in terms of this kind of work. But somehow the government said, no, you have to do it. The retrospective tax, there was no option, so I had to do it. And there, what I found was that the GAR concept is essential, but that teeth of a presumption that every taxpayer is first a tax evader, and then under our determination behaves well. That is entirely wrong. A taxpayer is primarily not a tax avoider or evader. My experience shows that because of the complexity and non-interpretability of tax law, they become tax avoiders. And of course, there are multinationals, there are exceptions, but by and large, multinationals also keep meticulous records. And so you just can't go after them willy-nilly like that. So our committee found that you would have to make it viable, grandfather some of these investments. You can't say that, okay, you have done the investments and so on and so forth, but we are going to fine-tooth comb, examine it, scrutinize it from now on. You have to see when they were invested and what were the conditions under which the interpretations could be done. So that we very much incorporated grandfathering as a necessity. Also, every GAR case that was taken up by administration had to be carried out by the assessing officer. And we felt that something more senior, also more senior officers have to be involved, and then approving panel was immediately modified, and commissioner and principal commissioner, they were also included. But then my feeling was that just administrators are not enough. We need a person, maybe a professor in this area and who are working in this field. Someone from outside has to be, who has got no axe to grind in all of this, also be a part of the approving panel to see, is this a correct case and what should be the result of this correct GAR case and the, so to speak, the diagnosis of GAR. So fortunately these kinds, and there were several other recommendations, but these two I wanted to say that the government did accept, and the GAR seems to be working. But as I lamentably say, that GAR is the litigation continues. Even in January 2026, there was a case of Tiger Global International 2 Holdings versus the authority, the tax authority, the authority of advanced rulings, and that came up, and the Supreme Court ruled in favor of the tax department. They quoted verbatim big chunks of the this report, the GAR report that we did, and so it continues and it doesn't abate. So my feeling is that GAR has to be simplified, make it easier for the good taxpayer. Don't take up cases that are marginal. These are important, and I feel that the current tax department has understood all that and are doing all this, but I'm not 100% sure. But at one point, I felt that they have seen the light of day and they are proceeding in the what the Supreme Court has said is that you can grandfather a particular investment, but suppose something took place and that investment was not just an investment but a whole arrangement, that is aspects of investment, this, that, you cannot grandfather such a thing. In fact, our committee had said that also. So the Supreme Court has taken that up, given that example quoted from the committee report, and said that therefore Tiger has lost the case in their judgment. But I've just heard today, while sitting in the office, that Kavita kindly allotted to me for a few hours, that Tiger again may, though they lost in the Supreme Court, in Indian Constitution allows them to revisit it and go to the judiciary again. So we'll have to wait and see the situation. Two more quick topics. One is the taxation of digital services. This has become very controversial. The point is, there are suppliers of digital services from abroad, and the domestic people, they are buying the digital services. So the income that is being generated goes directly abroad, and typically that should be taxed in the recipient country. So let us say India is buying services from abroad, and all that, they are making the payments for that, but no tax is being withheld. So countries began to say that, well, we need to do it, both emerging economies and advanced economies. And so the concept of digital services tax came into being. So countries began to impose digital services tax. And US Trade Representatives Office, or USTR, they looked into it and found this discriminatory, because the digital services tax was kind of something that went opposed to the US concept of where the capital or the brain of these services being provided reside. And so they believe in this kind of residence principle, and they said this is discriminatory. And whereas the other countries were saying that we are losing this potential tax revenue. There are huge chunks, and these companies that have become billionaires, maybe trillionaires, some of them, and but we are losing this potential tax revenue source. So countries began to introduce digital services tax willy-nilly at the point of the when the transfers took place to the service providers from abroad. Every country began, and which are the countries? And so the idea was that the OECD said that yes, there is a concept called virtual, or they introduced virtual PEs, and or permanent establishments. Permanent establishments are like in India, suppose a foreign thing is operating, and if it is has an office, etc., actually, and it is based in India, it's called a permanent establishment and is taxable. But suppose the service provided is from abroad, there is no permanent establishment in India. But the OECD said this is a virtual permanent establishment. As long as that company has a website in India, that is proof that it is a permanent establishment. It's called PVE. And on that basis, the tax was done, such companies began to be taxed. But US opposed. Why? Because the US companies like Google, Facebook, Amazon, Apple, they were providing these kinds of services. They didn't have offices in the recipient countries. They didn't want to pay tax. And they said this is what is they called residence principle. That is, the assets of these companies are abroad in the US, and the US should get the returns. And other one that on which digital services tax was based was the source principle. That is where the income was being generated, and so on and so forth, for these recipient services. And so there was a huge thing going on even today. And which other countries that US went against? Many countries. For example, India introduced a 6% originally equalization levy. It was called equalization because there was no other way to tax these service providers. Other countries that US took sort of very poor decisions against them: Austria, Brazil, Czech Republic, EU, France, Indonesia, Italy, Spain, Turkey, UK. And so in 2019, the USTR found that France's 3% digital services tax was unreasonable, unfair, and discriminatory towards US commerce. And what did it do? It imposed 100% tariff on French cheese and wine. thus depriving Americans of the best cheese and wine in the world. And similarly, in 21, the USTR found India, Italy, Turkey discriminated against US tech firms. And it went on. And the thing is, I didn't put it here, but I saw in June 26, reading the Financial Times, that the US has declared that it is going to put 100% tariff, after the US president likes to warn, 100% tariff on EU if it goes ahead with a digital services tax. And the EU Secretary General at about the same time declared all of EU will go together on the digital services tax, and it is anti-growth, anti-everything, to fragment ourselves on this matter. So let us see where it ends, whether the EU really can stand up. Well, I have my views on that, but that is what, at least for once, the EU has made a statement. So let's see. I'm not taking sides. And finally, I come, well, after BEPS, I'm going to talk just a little bit about robots. BEPS has been another attempt, and you have really represented India brilliantly in the OECD as for the BEPS, base erosion profit shifting attempt by all countries to see that multinationals, their tax base is not eroded. Multinationals became more and more known for distributing their profits across countries in such a way to put maximum profits in low tax jurisdictions and little profits in high tax jurisdictions. So it had nothing to do with actual production patterns, or had little to do with actual production patterns. So the whole, after the 2008 financial global crash, it was realized by country authorities that this is what is happening. Multinationals are often paying 2% of their taxable profits globally in tax, or 3%, etc. This has to stop. So this movement started, BEPS. And so they put together 15 actions in 13 final reports in October 2015. And I listed the 7 main kind of things that they focused on. There are many, when countries have tax treaties, there are some benefits to the two countries that emerge from that. Then some countries avoid being a permanent establishment. I already just explained what is a permanent establishment. They avoid willy-nilly because then they can avoid tax in that country where they are operating. Then the interest deduction, if you organize your balance sheet in such a way that you take a lot of loans on the book, then you can take a lot of interest for show and take all that deduction. And then prefer the joint ventures between companies, that they become joint ventures to take maximum advantage of the taxation as individual enterprises. When they combine, their tax burden reduces. And how do you deal with disputes? You might gloss over disputes, and then do you really exchange proper information on your tax matters? So these are the kinds of things that elaborate reports, country participation of more than 140 countries. So you can imagine the complexity, and all of this happened, and the reports were, and in fact, the important thing was the submission of data that were required. And first, there was a local file. All multinationals had to do it. Information on the inter-company, that is, if there are 2-3 companies in one place, what is the relationship of the transaction in each country that they had? Then a master file of the MNE, multinational enterprise group members, providing a level overview, a high-level overview of the global business of the multinational, and a report containing the member group's global allocation of income and taxes. So this was the most important thing, that in each country you have to show how much income and how much tax. If the income is high but the tax is low, it's a low tax jurisdiction. So you can be called to explain why you have done that. And so this was a very important element of that. Then this whole movement of OECD went into something called, because of the digital tax and all, Pillar 1 and Pillar 2. In Pillar 2, that said that can all the countries agree to have a minimum tax on digital services. And finally, they agreed on 15%, I think, 15%, but 15%. And I don't know, because Biden administration finally agreed on 15%, so the whole world agreed. Now in the new administration, I don't know. And then another thing was to the digital economy, how do you, you have a minimum tax, as I said, and the Pillar 1 was the taxing rights. As I said, if you have a source principle, then along the supply chain, you can tax all the suppliers. But if you don't have a source principle of the residents, then only those who own the assets will pay. So that was no agreement has taken place on Pillar 1, but Pillar 2, minimum tax, there is some agreement. Finally, taxation of artificial intelligence. This is my favorite topic now. And because I wrote a governance brief on this, and I read a lot about artificial intelligence, starting from German philosophers based in Oxford, this and that from last century. So it is who had predicted what. So, but then I still have to catch up on what is actually AI, but I'm using it a little bit. And so the thing is, contemporarily, the Financial Times on 19 June 2026 reported that the share values of Accenture, a major IT company, fell to their lowest level since 2017. And so Accenture cut its revenue forecast, leading to investor fears that the rapid advance of AI is undermining traditional IT and outsourcing businesses. So their March to May 2026 bookings fell by 3% to 19 billion compared to the same periods in 2025. So this is a foreboding that all these IT companies, how will they be affected? And at the same time, the Economist magazine, actually they call themselves a newspaper, the Economist reported several articles, research being conducted by researchers and corporate investigators on the impact of AI on employment. And some of them I've read summaries, are very interesting articles, and some of them are a bit, worrisome. So the long-term beneficial ramifications on humanity is not questioned, but the counterpoint is, if AI is going to replace labor or even traditional capital, there must be some fiscal contribution for reskilling of factors of production. And therefore, we have to tax robots as they replace white-collar, blue-collar labor, and that would need public resources. It seems to me that I developed this from the literature, available literature, this thing as to what do you want: an income tax, do you want an excise tax? As soon as you come to income tax, you have to define, is it going to be a personal or a juridical entity, robots, and all of that is there. But the main thing is, I found that number 2, you can have a quasi income tax on hypothetical robot salary, meaning it is not impossible, because you can think, if robots are being created and they are replacing ABC laborer, then you can take the salary of that ABC laborer and work out a presumptive income, and then put design. That's why I call it, and it is neutral between labor and capital treatment. You are not taxing any labor or capital in any non-neutral way. and design is achievable. That's what I feel. And revenue potential is very high because it's an income tax. So that's one possibility. Then disallowance of tax deductions and this and that won't happen, because no country is going to stop tax deductions for robot and artificial intelligence at this stage. They have to keep catching up. And the other thing I found was that number 6, VAT GST on robot activities. That, is very normal. Whatever it is, we have to include it as either services or as goods, whatever are being produced. So it is neutral between labor and capital. It is easy to design because it's just VAT and GST inclusion, and revenue potential is high. And finally, levy of selective excise duty, meaning you can, in excise duty, the advantage is you can have whatever rate you want. And so if you think that there is beneficial impact, then you can have a high excise duty, though this is kind of imaginative thinking that countries will agree to put very high excise duty on. But if it has to be done, because my feeling is suddenly countries will realize that we have a great problem in our hands with displaced labor of all grades. And so levy of selective excise duty, it is not obviously neutral because it is an excise duty. Design is very achievable, and revenue potential can be high depending on the excise rates. So you have to think of either a quasi income tax based on presumptive income, or you can think of a VAT, or you can think of selective excise duties, or all of them. But that is my hope, that societies will see that this is very important. And South Korea was giving, which is the most society of most IT and our AI oriented society. Lots of incentives were being given. Suddenly they realized that their unemployment rate has gone up tremendously. So they just withdrew the income corporate tax rebates and all that they were given, and they studied, and their unemployment rates fell ostensibly and very clearly. So I think that AI is something, not just what it is contributing, is it going to water, what is happening, they are all important. But to me, what resources are they going to give in order we can reskill those who are being displaced? And they will come in multitudes. So with that, and thank you for your patience. I must have gone overboard and talked, but thank you for your patience. Thanks a lot, Kavita. Thank all of you.
Thank you very much, Dr. Shome, for a great overview of the journey of Indian tax reforms. I'm sure there are people who have questions and comments, so we'll open up the floor for questions. Anybody like to start? Yeah.
Thank you, sir, for such a excellent presentation, and also the discussion over the history of taxation and Indian system. We often look for this kind of talk. Basically, most of the cases that it's not documented all the thing. So my question is related to basically your this thing. Basically, as we know that alcohol taxation is completely under state tax system, because central government in the union list, there's nothing called alcohol in that, except the medicinal and toilet preparatory, that thing. Under which act the central government put the custom duty on alcohol? Basically, custom duty on alcohol, if the central government collects that, if there is no under the union list and that thing, then which empowers the union government to collect the tax? And second thing, that we have now the FTS, the free trade agreement with the UK, then Australia, now we'll have the US and that thing. Whether the state government, because it's a very good source of revenue for the state government from alcohol, can have a countervailing duty. What is the revenue loss is happening due to the reduction of the custom rate reduction, state government can put tax on that when the goods are coming to their jurisdiction, because they have full right to that thing, and we are not avoiding the FTAs and that thing. That is the thought that I want to. And the another side, mainly the thing is that on data, taxation of data, because as we see that whatever we do, all these things are data is collected, and we are everywhere digitally surveillance is going on. So can we thought of taxing the data itself? When the government could be a trustee of public data, and it's a kind of royalty, a kind of system, because all of us were subject to the government and under the sovereign, and sovereign is the public trust of our data and in our information, and their government can collect the royalty or any kind of tax. Your thoughts on this? Thank you, sir.
Basically are yes, in the sense that the countervailing duty, before going to countervailing duty, the central government imposes the tax because anything, the central government can impose any customs tariff, because that is in the union list, customs tariffs, that is therefore the central government. But there's always a countervailing duty to show that if there's a state level tax like GST, etc., countervailing duty can be imposed, and for, let's say, GST portion, but of which state is a part. So whether a countervailing duty should be imposed, my own view will be yes. So the states have to really negotiate and get that, and so it can be done. In terms of data, that's a very, I never thought about it, but now that you've mentioned it, that I think is also both a new goods and a new service. So if it is so, and new things are being created, they have to be taxable. You know, I hate to say this, tax specialist, whenever, in fact, my mother used to say, I must say to my friends if they came home, don't talk too much to him because he'll think of a new tax thing. So, you know, but the thing is that countries have to, as long as they don't, it's not wasted. And I think that new sources of activities, etc., they have to then provide the quid pro quo and provide a tax base. And as our economy grows, infrastructure, etc., we have to find them. So I think data could be a very good source. And as you're saying, if government manages it, it can either take it in the form of royalty and leave the management to the private sector, or it can, because it cannot manage itself all of data. But some regulation, like the stock market is regulated. In that sense, I feel that in the future, data has to be regulated in terms of production of data and all that. I'm not saying control of data, regulated in the sense of, you know, tracking what is available, what is not, and all that. So data is also something, but that has to be, I think, to begin with, at the central level, some body, I think some committee or commissioners to look into these advanced topics on artificial intelligence, data, what are the side effects on water and all resources, everything put together, I think has to be started without getting bogged down. Because what worries me also is that if you really look at China, it is going forward leaps and bounds. I don't know if there were any Chinese or Chinese empathy people. I'm not opposed to China, but when I see how with undervalued currency, with their SEZs, which were so, they didn't even have 20 SEZs all these years, but each one was a space colony. I've been to 2 of them, and they had, like, I think 14 or 15 altogether. And the way they produced and how did they do all the technology, they told US multinationals in particular to come. They came, and if they complained, oh, we don't like this labor force, they would change the next day and give. We didn't have the wherewithal to do all that, and we shouldn't. I think we can't just willy-nilly change labor, etc. So, but what will be the alternative? We have to think. You know, we had instead 160 SEZs, which to me, which I was there at that time, and I thought, well, this is a real estate agent, you know. And so they didn't perform. So I think that we have to. And then in AI, the platform that the Chinese use, the platforms were actually taken from Silicon Valley in the US, but they converted it, etc., etc. While the US didn't bother, they gave the whole platform away every time. Well, the Chinese never. They said, "What is it that you want in particular? What is the software attached? We won't give you the hardware on it." So there have to be strategies. I don't know. We have to grow a little bit more aware of what is happening in the rest of the world. No, it is not important to me, frankly, and I'm going off whether we are third in coal production in the world. Obviously, that's a natural result, and so on and so forth. We have to really push hard if we are to keep up. And we are such a large country, we have all the resources in order to be able to do that. But that is like one of these thick books on India. That was,
India of the future.
India,
2047.
etc., etc.
Anybody else has questions, comments? Yeah.
Two quick questions.
Come closer to the mic.
Okay. One is related to Vito Tanzi and others are arguing that one of the major causes of corruption is political funding. And given the huge political funding through electoral bonds or otherwise, the kind of contributions individuals and corporates are making in our country, given that how to improve tax compliance vis-a-vis the direct taxes, particularly income tax and profit tax. That's one. And second question is regarding round tripping. I mean, we all know that we have double taxation agreement treaties, avoidance agreement treaties with known tax havens like Mauritius, Singapore, Cayman Island, and British Virgin Island, and so on and so forth. So what are your views on that? Thank you.
Very good question. First is, corruption. Indian government has tried so much, and I do believe that all governments have cut down corruption a little bit. But our democracy has taken shape in a particular direction. And so to me, that has to be redirected somehow. And it can only come from the political masters, really. So I feel that,
Come a little
yeah, that is what I'm doing. Yeah. But I don't think I can say more without sounding revolutionary, But basically, it's a matter of national resolve. I see, I've lived in the UK several years, and I saw that despite the mistakes that they've made, now they have the 7th Prime Minister in 10 years. But they are fledgling, but they go through it and they don't have corruption. They have something in the margin and all that. So they are still willing to do that. And they were our colonial masters and all that. So I hate to say that, especially our generation, anything good about like that. But you have to say things are. But of course, I don't agree with the kind of subsidies that they give without any concern on the fiscal deficit or anything. And then actually the taxpayers suffer. All of that is there. But I'm saying that you can have a society without corruption and democracy. You can have. So India's resolve is, is what is wanting. And there was, I think, Netflix series called Panchayat. I don't know how many of you saw it. I saw it because it was recommended by a very close friend. And I don't usually watch those series, but I really enjoyed it because it gave me an idea that even in that level, how corruption seeps in. And on your second question about round tripping, it is very difficult to explain how complex the application of tax treaties can be and the development of a tax treaty. When I was in the ministry, there was one joint secretary, a brilliant lady, who used to go all over the world trying to do these tax treaties. It took forever, like 15 years to come to a joint tax treaty with South Korea. And then there was criticism, oh, she's the only one who's going to the same thing again and again, foreign trips. So I called officers who were saying that. I said, you want to go leave your family all the time and go to South Korea. You don't, you'll have to eat South Korean food. You'll have to, have you thought about it? So meekly, they agreed. But she really almost gave up her personal life in order to do what she was doing. You have others also have done, contributed back and forth to participate in BEPS and this and that. So I think that round tripping is all the tax treaty context. Everything is step by step by step. It takes forever. And once we achieve it, it is most important to adhere and stick to the tax treaty. And of course, the tax treaty can be interpreted in different ways. And there is a lot of controversy on the same tax treaty because your more powerful partner may not have the same interpretation as you. And when you agree to a tax treaty, you may not be to have understood fully what you signed. So then you have to renegotiate, etc., etc. And regarding Mauritius and all that, we know there was we worked so hard to put on the certificate. Even that was being this thing. And I always used to say about the Mauritius, because I'm not in government, I can say, they said when they needed us, they would say we are your cousins. And then when they didn't need us, they would say we are French. And so I found the Mauritians very friendly, very nice people from a small island in the middle of this thing. I was there admiring because from sugar cane field workers, they became a multi national kind of center of financial matters. But they were doing the round tripping and they were doing all these, allowing the round tripping. They were basically, those who don't know, they were allowing multinationals to come in through Mauritius and get a almost zero tax. And the Indian government had to accept, because of the tax treaty, that they were paying tax in Mauritius, however small the tax was that they were paying. And this was being questioned rightly by the income tax department. And so we had to work with the income tax department and make some corrections. And finally, the Mauritians agreed that they would they would not allow this kind of round tripping. Then Singapore also came in on the same thing. Cayman Islands, so one by one they had to be negotiated, but they all creep back in. That's from my experience. But you have to keep plugging on. So I made macro statements, but when you go deep into all these practices, those who actually do it in the tax departments, on a day-to-day basis, they are the worker bees, and they do this marvelous job of going to countries, working out, facing the powerful countries and doing all this. And Mauritius was backed by the most powerful countries because they were sending the investment through Mauritius. And I have also found elderly politicians who are very good. Some of them had I won't mention the states, they had even distant cousins in Mauritius who had gone 2 generations back. They knew because of their village structure that they would not take any measure against Mauritius. Because the Mauritians would come in. So there are so many quasi-political factors. So it took decades, I think 30 years or so, to get Mauritius to accept, and that happened when I was there. I mean, I use some, frankly, I won't say all that, but that they agreed to move away from the round tripping arrangements that they were. So we have to recognize when Indian authorities finally take measures and they are successful in curbing this kind of thing.
Thank you for a very nice talk. One thing that intrigued me was in India, corporations have a choice between 2 regimes. So what in general do you think of sort of this optionality for businesses to choose one regime versus the other? Now there's of course this alternative minimum tax, which puts a floor, but what is in general your sort of perspective on this?
The minimum alternate tax applies to any regime. You have to pay. And between the two, and which is very important to have, the minimum. And most even European countries now have minimum taxes, but may not be calculated on this defined books profits and all that. Each country has its own. As far as the alternatives between the two corporate regimes, I think it's very innovative. At the beginning, when it came, I was wondering, what is this now? Because policymakers have this habit of innovation, to leave a mark. But I mean, tomorrow there's going to be a presentation on the situation of this alternative. But my own feeling is both individual income tax and corporate income tax, depending on how the tax incentives are affecting you. If you don't get benefit from tax incentives, then you forego tax incentives and opt for a lower tax rate. In individual income tax, it's the same thing. If you're not interested in all these incentives, etc., you forego and you opt for a lower marginal rates of income tax, and you also are covered against inflation in a better way. So and India is the first one that has had this alternative regimes in both the taxes, direct taxes. The only thing I'm saying is that in the old regime in corporate income tax, which also continues now, you can get all the incentives, and that incentives, because they distort the price mechanism, they cause distortion across the board among enterprises. So something needs to be done about that. But in a way, slowly phase out probably the old system with incentives, or begin to cut down the incentives. Because as I said, in Annexure 7 of the budget, if you look, the revenue losses still very much there from incentives. So I think that it's a very good system. I not only accept, but I like the system. It's very innovative, and but I think the incidence and weight of impact and ramifications of tax incentives, they have to be cut back somehow. They have to think how to do it.
Thank you, sir, for such an enlightening talk. I would call it a tax awakening. I have one comment to make, something in addition to just what you just said in your lecture, and two additional questions. First of all, sir, you spoke of faceless tax administration. So I come from the Rajasthan tax administration, state GST department, and Rajasthan is the pioneer state to introduce faceless tax administration in the country in GST. We are yet to see the results because we've lately just now.
What is the thing that they have in Rajasthan? What is it?
Sir, faceless tax administration in GST.
GST. Okay.
Yes, sir. So this GSTN has developed a mechanism for that, and it is a little different from the income tax regime in the sense that only the intimation is going in a faceless manner through an authority which is not actually the jurisdictional officer of the taxpayer. But the moment it comes to the level of SCN, that is a show cause notice, then the jurisdictional authority will only issue the notice. Okay. But I am in agreement with, precisely in agreement with what you just said, and more so for the GST case where one authority is going to give the intimation and another one is going to give the SCN. So definitely, I don't see any very positive result coming out of it. So that was just a piece of information. One question that comes from what you just said was, talking of the federal structure of GST, although this is pushing a limit too far of your lecture as well as my limitation, but in seeking your opinion, humble opinion, sir, and it's a humble request from my side, do you really consider that GST in India is a federal structure? Because to a large extent, the state autonomy has been lost in not just the administration of the taxation system, but even as I go to the law committee, I go to the fitment committees, and I don't really see that happening. So what are your views on that, sir?
No, I feel that the structure which is jointly center and state, that I think, frankly, not that I am a centrist, I'm very much a federalist, but I think for the sake of administration, efficiency, I think that is a very unique and correct system. However, what you've raised is correct. I've been a permanent invitee to this MPARD Committee of State Finance Ministers for years. And not now, but once the VAT went, I also went away. But then I worked on the GST. But what I saw was the states have to act cohesively rather than reflecting their parties, because the finance ministers are representing their parties. They have to realize, yes, we belong to different parties, but here we are finance ministers. And it worked most of the time during my presence in that. And but sometimes that breaks down. That I think that if the states acted cohesively, then the issue of autonomy would not arise. Because then the claims of the states, I've seen that in Brazil, the states used to come, discuss all that, and even before they came to the meeting itself, they had discussed the technicality, the technique issues that they would discuss in the meeting. And that was very, very important. It was really a technical meeting. In our system, the ministers, some have technical competence, some don't. And they may be politically very astute and all. But they are the ones who will come. But they must bring their very strong officers who are working as, sounding boards and work it out. So I think it is practically difficult and challenging, but it can happen. Meaning there's no reason for autonomy to go. And autonomy meant what? Even before, the states were not getting too much revenue. If you saw, there was a lot of internecine rivalry among the states. Sales taxes, rates were being competitively bid down. The central sales tax, there was 2% or 4%. One would put a 3% in between. So there was no cohesion. There was no, when one speaks of autonomy and goes to history again, I've seen, in fact, I chaired the original Central Sales Tax Committee because I'm ageless. I go back so many years. And so I saw that I told them in that, first and foremost, you decide that we are a cohesive entity and the central government is encouraging us. Let us take advantage of this and do something. So it took a long time, but eventually we had a report that CST will be decreased from 4 to 3 to 2 and then eventually phased out when we have a full-fledged VAT. At that time, it was just sales taxes and all. So that cohesion that you say autonomy, that was not there. There was no autonomy was in a constitutional sense. And no one really followed the states. If you asked at that time also, they would say, what? Because there was no, basically, theoretically, there was autonomy. But in practice, it was what the states did. That's it. Instead, it came under proper cohesion as a whole. The states as a body today are states rather than fragmented here and there with, so when they come, but even there, they have to be constantly vigilant. They have to do that. So I think that therefore this arrangements, CGST, SGST and all that, it's very good because, and the center is seeing that the transfers from producing states to consuming states are being made. So it's a very, I think, advanced mechanism. We have to keep it and make it very, very operational. And in our society, the state, meaning capital S, the state, it just can't come in and say that we'll do this, we'll do that like China does. China doesn't even explain. It does whatever. I've been to several kind of, how shall I put it? Some missions, I would say, to see what they are doing. But that way, we have to live with our democracy. It is a full-fledged democracy, and operate within those parameters. And I do, to cut a long story short, I do believe the states have the autonomy, only they have to nurture it and push forward on it.
And there's one more question, sir. You already laid the foundation for that, sir. It's the same person, sir.
Who?
Sir.
Oh,
Sir, since you were a part of the Empowered Committee, so my third question, which I already had it in my mind, is when in the 2013 Empowered Committee, if I'm not wrong, January 2013, which was held in Bhubaneswar, it was decided that the same year GST was being introduced and CST would be completely phased out, both VAT and CST. And if at all it does not happen, then either the states will be given the power to increase the rate of, obviously the center would increase, but for the states from maybe 2 to 3% or something, or otherwise there was this was the option that was given there. But eventually, as we know, GST did not come up in 2013,
Correct.
and even in 2017 when it was introduced, the 6 goods are still left out of the purview of GST. But nobody is speaking of increasing the CST rate from 2%. Alternatively, one thing that came up in my mind a couple of years ago, and I even suggested it to my government, that if the rate is not coming up, then why should the state not be compensated for the difference for the 6 goods, which we are still running on 2%, and we already had the CST compensation in place, but that was also given up to 2012, and nobody is speaking of the balance compensation that is being lost to the states, and nobody is talking about the 6 goods on which either the rate should be increased or the compensation should be given. What are your views on that?
so, you're not. I think very few people know all this history, but I'm smiling because I was right in the thick of it, determining the formula of how states would be compensated by the center, even though the center had nothing to do with it, as we came into the process of the value-added tax. So if any state lost revenue because moving from sales tax to value-added tax, the first year the center would compensate 100% of the revenue loss. The second year, 75%. Third year, 50%. And after that, nothing. So this endless, without reassuring states wouldn't agree. They all we want resources. But I will tell the states in the Empowered Committee, be proud of your state. You have to say, why should you, and at that time, the current Chief Minister of Assam, he was the finance minister, he used to come, he was a very brilliant man. And he would have all kinds of arguments and all that, etc. But, the issue of compensation cannot go on forever. And with the GST, the revenue intake of states has gone out of trend, above trend. And therefore, I think the states should say that, in a way, I'll frankly confess that I feel CST or anything like that should not exist anymore, because it is a distortion. It is a tax on export of one state to another. And the GST's idea is to have a common market all over the country. That is what we were very proud of, to say it's all free-flowing goods and services across all states. So any distortion in that, to me, any tax that stops it is a distortion. We have to get out of it. So I think that if the states there are two things, from an economist point of view. If the states take away that, then you are taking away a distortion. Taking away any distortion in economics will generate growth in itself. Because all these price distortions of one commodity against another distorts the market, relative market mechanism, relative prices in the market mechanism. So if that improves, the product also must improve. There must be a little bit extra GDP, and that can be actually, economists actually do that kind of, they spend years calculating all those kinds of things, and publishing journals. And so I think that government will still agree to some compensation, etc. But the compensation was already done and given, calculated. I know there was a very brilliant IAS officer who was also a chartered accountant who used to work with me on that matter. And we worked out the thing, and everything was given. In fact, there were some funny episodes, which I won't take your time now. that happened, how states would argue themselves. I mean, if they joined in the third year, should they get 50% or should they get, what should they get? And my argument was, you're joining third year. You are not going to get, if it's in the last month of the third year, you should get the last month of the whole year. Why are you arguing for the whole year? Then my boss, the finance minister, was a brilliant lawyer. He said, Partha, you're wrong, because that state came from his coalition, I think. I said, no, sir, I'm not wrong. He said, no, because the law says if you, for the third year, you would be paid 50%. It doesn't say it will be prorated by month. So even if they come on the last day of the third year, they will get the full 50%. I said, yes, I accept defeat. So, so you have to accept the fact that compensation between states and center now, instead states should say at our level, what can we do to generate and propel state level GDP? That's what I feel. And some states are doing that. They are moving forward compared to other states are falling behind and all that. That is where the focus should be, not in the nitty-gritty of compensation.
Any other comments? Last question.
Yeah, thank you very much. Sir, you have, in 2 times you have mentioned that GST has benefited the states. GST has benefited the states, but actually, except Maharashtra, none of the major states got any benefit from the GST. Let me tell you the reason, what I have seen. The 2015-16 is the base year, the revenue subsumed into GST.
What was subsumed? Sorry.
Revenue subsumed into GST. Our base year is 2015-16. If we take the percentage of that revenue as a percentage of GSDP and take the present SGST collection, so if except Maharashtra and some states, some year, all the states SGST collection is lower than the base year revenue under protection as percentage of GSDP. So this is the fact is going on. Even the growth rate of SGST is some states is quite low, and that thing. So that paper will be coming out very soon. I have other papers in the earlier year, but up to 24, 25, I have done the analysis, and the paper will come out in EPW very soon. I will share with you, sir.
But, I would love to see your published paper when it's published. But I would say that, sometimes you're comparing apples and oranges, because under pre-GST, under VAT, one of the worst refund policies was in place. So what is the rate of refund now? What was the rate of refund then? If refunds are more automatic, some states like Rajasthan, I know, have kind of taken dynamic steps. Tamil Nadu has taken dynamic steps. Some other states have not. They have regressed. They would regress anyway because of the overall system. So I think that you have to take a look at that also. You have to take a look at the other parameters that have changed in the GST regime compared to the VAT regime. Are you seeing my point? And so you can't take ceteris paribus that everything is the same, has continued to be the same, and only this has changed.
The 2015-16, the revenue that I am talking about is basically audited statement of CAG audited statement. On the basis of that, the states got the revenue protection for the GST transition period. So it's apples versus apple, that comparison is there, because the 2015-16 was the base year. On the basis of that, states got the GST compensation.
Yeah.
So if I take that revenue as percentage of within the GSDP, that at least that much of the state government should get. I'm not asking that the more than that.
The state governments cannot be said to reform themselves, pay the pay back the input tax credit and all that in timely fashion, and say that and assume that it was the same before. So even though the audited accounts are showing that, at that time the audited accounts didn't ever look into at what rate have you given back your accumulated input tax credit. They sat on the credit and all that under the VAT. They just, they didn't. And in fact, they some allegations took place. In fact, I sent an auditor to take a look at it. The states will have to remain not mentioned. They were clearing past input tax credit which they had accumulated from the compensation, which was, that's why I'm saying I know that particular case, and they were showing that they were losing so much revenue suddenly. They were not, because actually if you kept the input tax credit refunds at the same rate, then they were gaining in the VAT. So there are cases, I'll tell you after this is over. But I'm not saying therefore stop your research, but I'm saying you have to keep in mind these kinds of things at a practical level.
Great. I think we've had a wonderful discussion. We took a little more than 1.5 hours. So thank you very much.